Hello everyone. Dear colleagues, my name is Yuehan Wang. Today I will present my research on the threshold effects of price co-movement between crude oil and dry bulk shipping markets. Now let's dive into this topic together. This study consists of 5 chapters, arranged in a logical progression from theoretical foundations to empirical analysis and concluding practical implications. To begin with, Chapter 1 is the introduction, which elaborates on the research background, existing research gaps and core research objectives. Chapter 2 is the literature review, sorting out the evolution of relevant studies and highlighting the innovative contributions of this paper. Chapter 3 introduces the research methodology and data sources. Chapter 4 presents and interprets the empirical test results. Finally, Chapter 5 summarizes the main conclusions and puts forward practical policy and industrial implications. Now let's move on to Chapter 1, the introduction. In this section, we will sort out the practical background of this research, point out the key limitations of existing literature, and then put forward the core research questions and research value of this paper, laying a solid foundation for the subsequent literature review and model design. Crude oil is the core commodity of the global energy system. Its price fluctuations transmit rapidly along supply chains and exert direct impacts on global production and trade patterns. Dry bulk shipping handles more than 80% of the world's bulk cargo trade. Bunker fuel costs account for 30% to 50% of vessels' total operating expenses. This cost structure makes the dry bulk shipping market highly sensitive to crude oil price swings, and oil price shocks act as a core driving force behind freight rate volatility. As the benchmark indicator for dry bulk freight rates, the Baltic Dry Index has long served as a leading signal of global trade and macroeconomic trends, which further underscores the practical value of investigating the co-movement between these two markets. Existing studies on the linkage between crude oil and dry bulk shipping markets mostly adopt linear time series models such as the standard TVAR model. Such models implicitly assume that the price transmission mechanism remains symmetric and stable at all times. In recent years, extreme events have frequently hit global commodity markets. Financial shocks, geopolitical conflicts, and public health emergencies all trigger structural breaks. During periods of drastic volatility, market participants undergo notable shifts in risk appetite, expectations, and decision-making behaviors, which eventually give rise to strong nonlinearity and asymmetry in price transmission. Linear models fail to accommodate such characteristics and cannot capture regime-dependent structural changes. This paper centers on one core research question: whether the price co-movement between crude oil and dry bulk shipping markets bears nonlinear threshold characteristics. We adopt the TVAR model for empirical analysis. The model can endogenously identify the threshold value based on raw data, divide the market into different regimes according to the threshold, and depict the heterogeneous transmission of price shocks under various market conditions. On the one hand, this research deepens our understanding of the nonlinear interaction mechanism between energy and shipping markets. On the other hand, it provides reliable decision-making references for relevant market participants. Next, we move to the literature review section. We will sort out the development context of existing studies and identify the research gaps that remain unaddressed, so as to further demonstrate the necessity of adopting the TVAR model to explore the nonlinear co-movement relationship in this paper. Early academic research on the price co-movement between crude oil and shipping markets centered on the linear cost transmission logic. Elizada and Nomikos 2004 verified a long-run equilibrium relationship between crude oil futures and tanker freight rates, and confirmed the existence of cross-market arbitrage opportunities. Stopford 2009 further pointed out that bunker fuel is the primary variable cost in shipping operations, and rises in crude oil prices will directly push up freight rates. Subsequent studies broadened the analytical perspective and illustrated that demand-side factors also exert profound impacts on their correlations. Oil price hikes driven by global economic expansion are usually accompanied by rising freight rates, While oil price fluctuations stemming from supply shocks tend to impose adverse impacts on the shipping market, existing literature has confirmed that the price co-movement between crude oil and dry bulk shipping markets presents obvious asymmetric heterogeneity, and the intensity of price transmission during high volatility periods is far greater than that in stable periods. Most mainstream studies adopt the Markov regime switching model, which exogenously sets the regime switching process and cannot endogenously identify thresholds based on data. There are three prominent research gaps in current literature: biased model specifications, lack of endogenous identification methods, and a severe shortage of studies focusing on the threshold effect between crude oil and dry bulk markets. These constitute the core innovative orientation of this paper. The VAR model was first proposed by TVAR in 1998, and it has become a mainstream tool for nonlinear research in economics and finance in recent years. The VAR model allows coefficients to vary with market regimes and can capture heterogeneous shock transmission effects through impulse response analysis, which perfectly fits the core research demands of this paper. Bai and Perrin refined the threshold estimation method in 2003, laying a solid methodological foundation for the application of the VAR model. Kilian's study in 2009 proved that oil price shocks deliver remarkably different structural transmission effects under distinct market volatility conditions, which further justifies the rationality of adopting the VAR model in our research. Through literature review, we have identified three core gaps in existing research: the exogenous regime assumption, incapability of endogenous threshold identification, and insufficient specialized studies focusing on crude oil and dry bulk markets. The VAR model adopted in this paper can well fill all these gaps. Next, I will elaborate on the research methodology and basic characteristics of our dataset, and demonstrate the rigor of our research design. This paper constructs a two-regime threshold vector autoregression VAR model. Taking crude oil return as the threshold variable, the model divides the market into low volatility and high volatility regimes and sets separate model equations for each regime. The model contains two core variables: crude oil return and Baltic dry index return. The intercept terms and coefficient matrices change across different regimes. The optimal lag order is selected based on the AIC criterion, and the optimal threshold value is estimated via the grid search method, which accurately captures the nonlinear co-movement characteristics under the two regimes. We adopt daily data spanning from January 2004 to June 2026, covering a full 22-year market cycle that fully incorporates extreme shocks such as financial crises and geopolitical conflicts. All raw data are sourced from authoritative official indicators released by the EIA and the Baltic Exchange, guaranteeing benchmarking the quality and reliability of the dataset. After data cleaning, we obtained a total of 5,628 valid observations, which met the core sample size requirements for empirical research and laid a solid foundation for the subsequent nonlinearity tests. The test results show that the ADF statistics of crude oil return and BDI return series are both lower than the critical value at the 1% significance level, with p-values equal to 0. The null hypothesis of unit root is strongly rejected. Both series satisfy the stationarity requirements, which meets the fundamental prerequisite for constructing VAR-type models. We take daily crude oil return as the threshold variable and estimate the optimal threshold value of 0.17% via the grid search method. This value splits the market into two regimes: the low volatility regime where daily crude oil return is below 0.17%, and the high volatility regime where the return exceeds 0.17%. The null hypothesis of linearity is strongly rejected at the 1% significance level, which verifies the existence of a prominent nonlinear threshold effect between the two markets and further confirms that the two-regime VAR model is suitable for this research. Now we move on to the core empirical analysis section, where we will interpret the specific outputs generated by our constructed model. The correlation between crude oil returns and BDI returns differs markedly across the two regimes. The correlation coefficient stands at 0.23 in the low volatility regime and drops to 0.15 in the high volatility regime, indicating that the positive co-movement between the two markets weakens considerably during high volatility periods. We estimate the orthogonalized impulse responses of BDI to a 1 standard deviation crude oil price shock under the two regimes to clarify the transmission relationship between the two markets. The results reveal that under normal market conditions, rising crude oil prices usually correspond to the expansion of global aggregate demand. The growth in demand boosts dry bulk trade volumes and freight rates simultaneously, and the positive demand side effect completely offsets the negative cost side effect. Such a result arises because oil price surges in high volatility periods are mostly driven by supply disruptions or geopolitical shocks. These shocks raise bunker fuel costs for shipping while curbing global aggregate demand, jointly exerting short-term downward pressure on freight rates. As market expectations adjust gradually, the impact of the shock fades rapidly, and the intensity of risk transmission increases significantly under high volatility circumstances. Next, we will proceed to the conclusions and implications section. We will summarize the core findings of this research, put forward targeted practical references based on the conclusions, and also prospect potential directions for future extended research. There exists an optimal threshold of 0.17% for crude oil returns, which divides the market into low volatility and high volatility regimes with markedly heterogeneous price transmission mechanisms between them. In the low volatility regime, crude oil prices exert a sustained positive impact on the BDI, reflecting demand-driven co-movement characteristics. By contrast, in the high volatility regime, crude oil prices generate an initial short-term negative shock to the BDI before the effect converges rapidly, embodying the combined cost and expectation shocks triggered by extreme events. Regime shifts are highly consistent with global economic cycles and geopolitical incidents. The positive correlation between the two markets weakens substantially during high volatility periods. The conclusions of this research can provide two categories of actionable practical guidance. First, for shipping companies, the proportion of bunker fuel hedging should be dynamically adjusted according to market volatility. Firms can moderately cut hedging ratios in low volatility periods to contain hedging costs, and raise hedging ratios during high volatility periods to offset drastic cost swings. Second, for commodity investors, close attention should be paid to geopolitical situations that disturb energy supply chains to prepare preemptive responses against extreme event shocks. Asset allocation strategies need to incorporate the nonlinear to regime linkage features so as to improve the risk-return profile of investment portfolios. This research not only provides empirical support for risk management in shipping and energy enterprises, but also adds new empirical evidence to studies concerning nonlinear price co-movement in commodity markets. Dear respected colleagues, thank you all for your careful attention. In this study, we clarified the market logic behind the daily crude oil return threshold of 0.17% and verified a prominent regime-dependent nonlinear transmission mechanism between crude oil and dry bulk shipping markets. The demand-driven co-movements in low volatility periods, as well as cost and expectation shocks prevailing in high volatility periods, are highly consistent with global macroeconomic cycles and extreme events. These findings not only deliver quantitative foundations for shipping companies to design bunker fuel hedging strategies, but also establish a new analytical framework for asset allocation and risk management across commodity markets. Moving forward, we aim to incorporate more macroeconomic variables into the model to further explore the complex interactions between energy and shipping markets, and continuously provide empirical evidence for industrial risk control and market value exploration. Thank you once again for your attention and support. We welcome any valuable comments and suggestions. Thank you.